That new number on inflation, worse than expected.
Workers from the world's largest iPhone factory have clashed violently with security forces.
Vladimir Putin authorized a special military operation in Ukraine.
Inflation has been at levels we haven't seen since the 1980s. And the US Federal Reserve, European Central Bank and the Bank of England have all resorted to raising interest rates higher than they have in decades.
The actions of central banks have gone a long way to taming inflation, and we believe that headline rates have now peaked and should start to come down. But interest rates are likely to be higher over the next 5 to 10 years than they have been over the past 10 to 15 years. A lot of this inflation was caused by higher energy prices and food prices relating to the war in Ukraine. But we think that this has now become much more ingrained in everyday goods and services.
Historically, the solution to high demand-led inflation would be a recession, catalysed by high interest rates. But this requires action from central banks.
We got the zero population growth problem, and we don't allow immigration anymore. So all the people who are the labor pool's not expanding.
There are several factors as to why we're going to struggle to see inflation coming back down to normal over the medium term. The first is the tightness in the labour market. During the pandemic, a lot of workers left the workforce due to long-term sickness, but that shortage created higher wage pressures. And companies are trying to work their way through this, and ideally more migration would help ease the situation, but that's become a very unpopular option due to political pressures. The second key factor is deglobalization. Globalization over the past 4 decades really helped to lower the production costs as goods were shifted to cheaper parts of the world for their manufacturing. However, rising geopolitical tensions and concerns around the fragility of supply chains, which became very apparent through the pandemic, is now causing companies to think about where those productions are located and also raising the costs of production as they seek to move them. And the third key factor that we're considering is decarbonisation. The need for the global economy to move to a more sustainable form of energy is likely to raise the cost of energy production for companies around the world.
Interest rates in real terms have been very negative of late. But against this backdrop, central banks will need to focus on fighting to keep inflation close to target rather than previously where they were trying to keep inflation up.
The trade-off between growth and inflation has worsened considerably compared to the previous regime. Central banks are now going to have to focus far more on lowering inflation than supporting growth as they have done in the past. This is likely to lead to significant implications for asset class returns, valuations, and also increased volatility for investors.
Central banks can't increase support each time growth falters, and any false hope of this happening could lead to misallocation. So investors will need to face economic realities if they want to overcome inflationary pressures.